Let's continue with this one. Now we'll talk about the cash flow statement, and the importance of the cash flow statements will become evident as we go along and start looking at live examples. But primarily, this tells you the cash position of the company. Remember, we had spoken in the P&L statement discussion that there is a possibility that you have sold goods, but you have not received money, right? But not received the money. Your cash flow statement should be able to account for this. Your cash flow statement should throw lights on this, right? Even otherwise, your P&L is susceptible to your accounting definition of things, right? And that might tell you that things look great, but cash flow is actually a fact. What money has gone out, what money has come in is clearly reported there, so you can't really have any sort of fudging of this. So they are they're less, they're not always completely, but less prone to any fraud, or let's say incorrect accounting practices. Cash flow statements can't really be fudged that easily, right? So just like our earlier discussion, there is a balance sheet at a particular point of time, there is a balance sheet next year. P&L account records the business transactions, but all the cash inflow and outflow that has happened from the company is recorded in the cash flow statement, right? And that becomes important. Now, cash flow statements, cash inflow and outflow could happen on account of three broad activities. You could have cash flow because of the nature of your operations. You sold something, you collected something, you made payments in the process, etc. You could have cash flow on account of creating new capacity or investments, right? So you have some money lying idle and you go and buy a new factory, or you sell an existing factory. That's all discussions on account of investments. And you could also have cash flow on account of either raising money or repaying that money. So you could have financing cash flows, right? So all the transactions that a company does can basically be divided into these three categories: operations, investments, and financing activities, right? Let's look at these in detail. Cash flow from operating activities is any cash flow due to the operations of the firm. So you sell something, you spend money in order to procure those sales, raw materials, etc. Everything is a part of the cash flow from operating activities, right? Usually, if you want to try and find out where do you relate this activity from, if you look at the profit and loss statement, most of the line items that come above the operating profit, above EBITDA, right? Earnings before interest, tax, depreciation, and amortization. Most of the line items above this correspond to cash from operating activities. So your sales, your costs, your receivables, your payables, your inventory, everything with respect to your data points come here. In addition to sales and cost which are there, receivables, payables, inventory can also be looked at the current portion, current assets or current liabilities, right? The current portion of your balance sheet plus the P&L. So P&L plus current portion of your balance sheet is where you will find most of these data points around cash from operating activities, right? And let's look at cash flow from investing activities. These are any cash flows due to investment activities such as buying or selling assets. Usually, you can relate this to all the non-current assets. Asset side of the balance sheet, right? That's where all your investments, all your fixed assets, movement in fixed assets, etc. would come in. Usually you can relate it to all the asset side of the balance sheet, and within that the non-current assets portion of it. Current assets are included in cash from operating activities, right? And when you look at cash from financing activities, this is any cash flows due to financing activities such as raising or deploying money either through equity or through debt. Even things like dividend payouts would come in here. Now, usually you can relate this to the liabilities side of the balance sheet. Again, non-current portion of the liabilities, right? So essentially, if you look at these three, cash from operating activities is typically from the P&L and current part of the balance sheet, current assets and current liabilities. Cash from investing activities is the asset side of the balance sheet, and that too non-current. And cash from financing activities is typically the liabilities side, and that too non-current liabilities. So the liability is the non-current portion of the liabilities come in here, right? Let's take a couple of simple examples to understand how do you kind of look at cash flows and how do you interpret these line items. We'll get into detailed understanding of line items again as we take examples of companies and look at samples there. But broadly speaking, the three line items give us some inference. For example, so let's say we have a company A and we have a company B. Let's look at both these companies. In these cash flow statements, a positive number is an inflow and a negative number is an outflow of cash, right? So let's look at company A first. We have a company that generates 100 crore, let's assume this is in rupees crore, 100 crore from operations. It invests about 150 crore and it raises some money either through debt or equity. Let's assume debt, 40 crore. There's a net increase in cash of minus 10, which means there is a cash outflow during the year. But if you think about it, the company is possibly expanding capacity, possibly, we don't know the details, but if you look at it, and expanding capacity by using funding from own money, right? How much of the own money is that? That's about 110, 100 coming from here and 10 coming from their earlier cash balances and debt, which is about 40, right? So you have this happening where they are expanding capacity by about 150 and 110 out of this is coming from their own operational money every year that they generate and 40 from debt. So it's not a very heavily debt laden capex that they are doing. It looks like healthy standard capital expansion, primarily with about 60 to 70% of own money and about 30 odd percent of debt that the company has taken, which is how most companies operate, right? Let's, on the contrary, try and see what company B is doing. Company B, if you see, is losing money on operations, right? There is an inflow that is happening on account of cash from investing, and there's an outflow in terms of cash from financing activities. Now, if there is an outflow when you're not really generating cash, then it is unlikely this is on account of dividends, right? This should not be dividends for most practical firms, right? Which means it looks like there is a debt repayment that is coming. Now, debt repayment was scheduled of about 100 crores, but the company could not generate cash from operations. So operationally loss making, right? Operationally, they're not generating cash, they're losing money. And how do you repay the debt otherwise? So you will be forced to sell assets, either investments or assets, which is what seems to be happening. There is an inflow because there must have been a sale of assets here. So even though the overall number looks positive on the cash flow, you have to dig deeper and find out where is that number coming from. Is the company increasing capacity by a lot of debt? Is the company repaying debt, and how is it funding that repayment, right? So the cash flow statements actually start giving these sort of insights about the company. And because these are kind of these are data points around cash inflow and outflow of the company, so unless the banker agrees to what you want to show here, typically you can't really change this data because the data is available with the bank and it'll get audited as well. So unless it is an outright fraud, it is very difficult to really change anything in the cash flow statement. This is a fact. This is number that will come directly out of your working. You can't really have an accounting policy and say I'll charge a higher depreciation or lower depreciation this year. That cannot be done with the cash flow. So cash flow is absolute amount of money coming in and money going out, and that gives you a very good interpretation of what the company is up to, right? Again, this would be more clearer and there are more line items that would follow between these major headers as we go along. More on that as we go along and look at a sample case where this will get expanded to considerable detail. And we'll pick up a simple company and try and look at details about that company in terms of what those cash flows, P&L, and balance sheet are in subsequent sections. Thank you.